Yo, welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today we've got another Simply Wall Street Journal for you, and I'm going to be talking about coping with a crash. Look, over the past week, we've seen some absolutely significant factors that has taken a hammer into not only mine, but a lot of your portfolios as well, as I've been talking to you guys in the community. And I want to really dedicate this episode to how to deal with crashes, mini crashes of some kind, how to deal with crashes in general, how to take the emotional side out of investing, and how best to deal with situations like we're currently seeing now. So if you want to be equipped in the down market and equipped when your stocks take a battering, then please like, please comment, please subscribe. On a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But today, let's talk about coping with a crash, and I'm going to start by letting you guys know that I'm officially part of the 0.1% club, as you can see on your screen. No, that doesn't mean I'm part of the 0.1% richest, most wealthiest, most handsomest people on the planet. My mum thinks I am, but that's neither here nor there. It means that I've gone from 7.34% down to 0.1% in little less than a week. In fact, in less than a week. It's been less than a week. And obviously that's an astronomical loss at the moment. Being comfortably in profit, being at a very good, average compared to the market, particularly the UK market, slightly less than the US market in terms of performance, but, definitely above the UK market when I last checked. And now to really be dealing with 0.1%. And now if you look at my, what that comprises of, a £332 loss in capital gains. Dividends been holding me up, so thank you to all of my dividends. There's been some currency improvement just because of the fact that the pound has gone weaker compared to the dollar, so the stocks that I've got in US dollars are now worth slightly more in pounds, if that makes sense. And I'm going to do a video on how a weak pound can impact your portfolio, but I've kind of given you a brief overview there, but still watch the video when I bring that out. And obviously this is what my total return is. £11 enough for me to get maybe a couple peach iced teas, maybe a muffin as well, and that's what we invest for. We invest for peach iced tea and the muffin. No, we don't. We invest to become wealthy in the future. And you know what, we are all going to deal with crashes of a small kind or of different magnitudes throughout the course of our investing careers. And what I want to kind of talk to you today about is how to really cope with that situation. But first, if we take a look at my portfolio, you can currently see my China ETF not doing so well, Lloyd's Bank not doing so well, CYBG doing terrible. My pie was very green before. Last time I did a portfolio update, it was 7.34% in the green. My pie was very green. It was very vegan, very renewable, ethical, vegan friendly, sustainable, all of that good stuff. And now there's a lot of red in my pie, and there's a lot of red meat in my pie, and it's just not healthy. And that's an analogy I've just made up right now, but it seems to work. So I want to get my pie green. I want to get it vegan. I want to get it looking healthy again. And I'm going to talk to you about different ways you can do that, but also how to cope with a crash. Now, in investing, I would say if you look at investing as a pie, so investing into the stock market, investing your hard-earned cash, your hard-earned money, how you can actually use the stock market in order to generate wealth, I would say that you can split it into different segments that affects different components that basically affect your performance. And I would say the first segment is 25% financial. I would say investing in the stock market is 25% financial. And what I mean by that is that financial information about a company, whether it's dividends, whether it's their cash, their debt, their PE, PEG ratios, their price to books, their assets, whether it's cover, whether it's yield, whether all of those factors that we look at in all of the videos that you've currently seen on the channel, all of those fundamental key elements, I would say that is 25% of the market. It's about the actual finances, the actual balance sheet of the individual companies that you choose to invest in. I would say 45% of the market, so just shy of half the market, I would say, is actually sentiment. And we've talked about this in multiple videos, and we've seen examples in multiple videos that sentiment really drives the market. If somebody influential, whether it's an institution or an influential individual, says something in the wrong or the right way, it can have a major effect on people's perception, and therefore people will act, and therefore the sentiment will drive the way you see the market. And that's why sometimes you can see market spikes or market crashes, and you can really correlate it to what somebody has said. A good example of that is Elon Musk, when he said that I'm going to buy the shares back and take Tesla private when it hits 400, and you saw the shares start to rise. That is where sentiment can really drive the market. So I would say 10% of the market is luck. Now, there is an element of luck in the market, but I don't believe luck is the lion's share of the market. I do believe luck exists, but I would say it's only 10%. An example of luck in my personal portfolio, as you can see, is Vodafone Group sitting here at 11.24%. Vodafone Group, there was a time when it was my worst performing stock for the entire time. And all of a sudden, they decided to do a spin-off of TowerCo, and that shot everybody's stock, everybody's share price up that had invested into Vodafone. Now, nobody knew about that spin-off. There was no insider information. It wasn't leaked. It wasn't fundamental data that we kind of acquired. It just happened. It was just announced, and then obviously the share price skyrocketed. So that is an element of luck. And if you invested in Vodafone after that, then obviously you didn't benefit from that rise. But if you invested in Vodafone before that, as I did, then obviously I benefited from that rise. But I can't attribute that rise to my shrewd calculations or decision makings or my shrewd analysis of the Vodafone stock. That is an example where that 11.24% that I'm currently experiencing with Vodafone was to do with a bit of luck, if I'm absolutely honest. But for those mathematicians out there, that makes 80%. 25% financial, 45% sentiment, 10% luck. The last 20% is emotion. Emotion for me makes up 20% of the stock market. If you can learn to manage your emotions through the good times and through the bad times, then you are well on your way to being an absolutely impeccable investor, because emotions will make you create decisions and put yourself in situations that you actually didn't really want to put yourself in. I'm going to give you an example where somebody in our community mentioned to me that my stock has gone down 20%. Only last week, my stock has gone down 20%. Should I sell? Now, obviously, I said I'm not going to advise you whether to buy or sell any particular stock, but I will ask you this one question, my friend. Why would you sell at 20%? What would motivate you to be selling at 20%? And, the answer was, well, actually, then should I buy? And that is what you've really got to think about. You've got to remember that your shares are investments for the long term. And if you bought it just only a month ago and it's dropped 20%, what is the reason that you are going to sell just because it's dropped within a month? That shouldn't be a reason to sell. And a lot of investors, a lot of experienced investors will tell you, in fact, that is a reason to buy. But it's all about controlling your emotions, and emotions make a big part. I will leave this link in the description, how to avoid emotional investing, and it's got a lot of good points. But I wanted to talk about one of the points that it mentions about how to avoid emotional investing and one of the strategies to take emotion out of investing. And then I'm going to give you my 5 tips, my approved 5 tips to cope with a market crash. Now, the first tip, which correlates with what it mentions here, is to take the dollar cost averaging approach. So what it mentions here is comprehensively, there are strategies, however, that can alleviate the guesswork and reduce the effort of poorly timing fund flows. 2 of the most popular include dollar cost averaging and diversification. The most effective tends to be dollar cost averaging of investment dollars. Now, you guys already know, those of you that have been following my portfolio updates, the approach I take to investing is the dollar cost averaging approach. I put a set amount of money aside every month consistently to ride out the highs and lows into all of the stocks that I currently hold. And the reason why I do that is to, one, alleviate and to minimize the risk of the down cycles, and also the risk of buying at a too high a price, and to steadily get a nice average return over the long term. And that for me was working as of last week, but obviously this week is a different story, but it will continue to work. And actually this week is a very, very good example that now that my portfolio has gone down to only 0.1%, that potentially is buying opportunities which will allow me to average more money in at a lower share price, which will then make my return greater in the future when things do start to recover. So dollar cost averaging, I think, is one of the most safest strategies for any new investor to get into the market. What is this picture? Is this baked beans? Is this, I don't know what that is, but so I'm just going to move that out of my screen because it's making me itch. So I would recommend dollar cost averaging as one of those, approaches. And, these current market conditions where things are low can be, really, really good opportunities, providing that there's nothing really, really significantly wrong with the stocks that you're investing in, can be good opportunities to benefit. So I would say that is number one for how to cope with the crash. Number two, for how to cope with a crash, is go back to your investment goals and remind yourself what your plans are. Are you in it for a quick flip, or are you in it for the long term? In my videos before, I mentioned to you that you need to have an investment goal. What type of investor are you? Are you long term? Are you active? Are you passive? Are you for dividends, value, growth? If you are someone that wants to quickly flip stocks and make money, then obviously this crash, or this slight downturn, shall we say, is going to be concerning to you, because you want to try and make money and flip it in a short time frame. But if you are investing over the long term, then you should not really be worried about intraday, intra-week, intra-month, and even intra-year movements in share price, because things generally recover, and over the long term the market tends to rise. So go back to your goals. Understand, are you in it in dividends? Are you trying to get a certain amount of dividend income? If you are, have you reached it? If you are reaching it, then are you really worried about the capital gain depreciation if you're getting the dividends? What are your long-term goals? And once you remind yourself what your long-term goals, I think the intraday, intra-week, intra-month movements are going to have less of effects on your emotional investment state of mind when you're sort of looking at your portfolio and you're wondering why things are going the way that they are going. Number three, this is something that I do, and it's a small technique that I think is quite powerful in making me feel a little bit better about when things aren't going so well. So what I do, I pick a random stock. So today I'm just going to pick Aviva, just because it's in the middle of the screen. And when I'm in a down cycle like this and I'm not doing so well, what I like to do is go and take a look at a graph in history for one of the stocks that I currently hold. So as an example, I could say look at 2017 for Aviva. And what I do, I put myself in a position of buying at a high point and buying at a low point, and seeing what I would be going through had I bought at that point in the past. And it's just more of a mental thing. This is an emotional side of things. So as an example, I might say, all right, cool. On the 5th of October, if I bought at £4.90, then you know what? On the 15th of January, I'll be laughing. 4 months later, I would have made, I don't know, 15% or whatever that is, and I'll be in a very, very happy and jovial mood. So, when I'm buying at a low price, and when things are rising, I'm going to be extremely excited. But if I bought on the 19th of January at £5.35, then as you can see, on the 12th of February, which is not that long after, it dropped right back to £4.94. Or you could take even longer term view. I might have bought at £4.97 on the 6th of October, and then 4 months later, it's £4.93, and it's gone up and down, but it's gone lower than what I bought it at 4 months ago. And you can kind of see how this trend can repeat itself. But what you can also see is how it tends to increase over the long term. I'm just going to refresh that, just because Simply Wall Street graphs are a little bit suspect when things like that happen. But what you can kind of see is that over the long term, it tends to generally go in the right direction, but there will always be peaks and troughs that you need to obviously consider. And so if you look at historic graph behavior, you will always see that there'll always be times when the market is depressed, times when the market is low. And so that should encourage you that if it recovered once before and it's a good stock with great fundamentals, a good balance sheet, good dividends, good capital, good profit, good margins, then it will recover again. It's just going to be a matter of time. So if you're, in a down period with one of your stocks at the moment, just look back at its history, see it go up and down, and just, give yourself some capacity to think, I'm going to give it a couple of months where I think actually it's going to recover within that time period. And honestly, I do think it actually genuinely helps. Number 4 is remember to sell and reinvest when profitable. Now, this is something that I don't do too often, primarily because I actually am a very long-term investor and I don't intend to sell any of my stocks in the short term. However, there are some times when it's actually worth selling. I've sold some stocks, so if I expose some of my liquidated stocks, you will find that I sold Man Group and I sold Weibo. Now, I primarily sold those stocks at a very low return of investment just because I didn't feel they fit with my current portfolio and my current strategy. So because of my strategy, I took a strategic decision to take those stocks out of my portfolio. But you might take a financial decision to sell a stock, which could be that you're in a position like Sentiment at the moment where I'm up 33.54%, and actually I might want to claim that profit, call it a day, part ways with Sentiment and say thank you very much, I'm going to take that 33.54%. And there is sometimes the right time to do that. If I take Sentiment as a personal example, being this high for me, this could be something that I should consider about selling. But the only reason why I wouldn't personally sell Sentiment is because the market is so depressed at the moment. People are flocking away from equities. They're flocking towards commodities, whether it's cryptocurrency or whether it's traditional commodities like oil, gas. Well, not really oil actually, but more like silver, gold, platinum, etc. And because Sentiment is a gold miner, there is a halo effect that benefits from that movement. And I think that's going to continue whilst there's a lot of uncertainty with the trade war, while there's a lot of uncertainty with Brexit, and whilst there's just a general market sentiment that's quite down, quite a bearish market. Gold tends it's going to still, for me, perform well. So that's the reason why I'll continue to hold it. And I've had some of you guys that have told me, Curtis, I'm really upset because I sold Vodafone when it was 10%, or I sold Sentiment when it was at 15% profit. I should have just held. No, you did the right thing. You did what you felt was right for that time. And I think, it takes courage to actually sell a stock and to actually get rid of a stock and claim the profit. Don't ever feel that you're missing out. Sometimes you might sell a little bit too early. However, it's better to sell too early and take a profit than to sell too late and have to sell at a loss. So anytime you sell, anytime you make a profit, it's always a good news story. So remember to sell whenever you think it's the right time to sell and whenever you think, actually, I've got the most I can potentially get. However, if you don't want to sell, if you're like me, you want to stick it out for the long term, the stock pays a dividend, or you see that there's a lot of long-term potential, then obviously you have to find a way to manage your emotions when there is times when it's going to be low, because obviously you're going to have to keep on maintaining and investing during those periods until it decides to rise again. The last tip, number 5, is to not panic. Guys, just don't panic. Like I said, unless it's an absolute issue with the particular stock that you're working with at the moment. And I'll give you an example of Sirius Minerals. So if you take Sirius Minerals today, Sirius Minerals was trading at about 14.67. They announced that they're no longer going to issue their 500 million pound bond, which kind of means now that they might not have enough money to run up until September. And you can see how the stock basically dropped instantly, like significantly, and obviously it's continuing trading now at like 10p, and it looks like it's on a downward trend, on a downward curve. If you're looking at the MACD indicator, it does look like there is no positivity in sight at the moment. If you're looking at the RSI indicator, it's very oversold. People are selling off Sirius Minerals. So in these types of scenarios, you might actually think, you know what, it might wind its way all the way down to zero, just like Debenhams did, effectively. And in that instance, I might cut my losses, I might sell, and I wouldn't call that a panic decision. I would call that a quite wise and informed decision. I will just caveat, I don't know what's going to happen with Serious Minerals, but there will be times when stocks will look like this, and actually it's nothing to do with the stock themselves. They haven't done anything particularly wrong. It's just the market conditions that have caused it to act this way. And I would say in those scenarios, definitely do not panic. Try and ride it out. If you have the means, try and invest more, and buy at those lower prices and get those discounts, and obviously, you know, hopefully the stock will rise in the future. I always talk about buying opportunities, and you know, this is the way to really look at it. CYBG being 19% down, that's a 19% discount on CYBG stock. Lloyd's is 11.49% discount. Imperial Brands is a 5% discount. And you know, these stocks currently are discounted stocks. They're undervalued from my perspective, and so they are buying opportunities for the long term. They're opportunities to get stocks at a cheaper price, get more shares, which then means you can get a stronger dividend payment on those shares, and also benefit from a better capital gain appreciation when they do eventually rise. So you know, when you're coping with the crash, there's all of those things to consider. So number one, if you're not dollar cost averaging, I would recommend you looking into the dollar cost averaging approach, maybe not for your whole portfolio, but for an element of your portfolio, so that you can ride out these highs and lows without even having to open your investment app or even look into it. Number two, go back to your investment goals and remind yourself, what are your plans? How long are you in it for? 5 years, 10 years, 15 years, 20 years, 30 years, 35, 40 years. If you are, try not to worry about the intraday, week, month, year movements, because if you're in it for a 40-year period, then honestly, what happens over these next 3 months is very inconsequential. Number three, look at the history of any stock and see that there's always peaks and troughs of magnificent magnitudes and proportions, and understand that this is just a trough moment and it will pass. You know, it will pass. There will always be times when things are going to go bad, but in the future things will get better. Number four, remember to sell and reinvest when you're profitable. There will be times that you need to sell your stock, and remember to do so. Grab your profit. Do not fear missing out. Do not sell and see the stock rising again and then go quickly buy it again, trying to, you know, get a little bit more money. That's called greed. Okay, that's greed, and that is not healthy in the investment world. You need to cut your losses. Take your profits, not really cut your losses, because you're not losing. You need to take your profits and, you know, then find your next better investment opportunity that meets the criteria that you have set out for yourself. And number five, do not panic. Do not rush to sell when things are down. Do not rush to sell when things are down 20%. Just generally try not to panic, and obviously I think you will have a much more successful investment career. I hope you found this video useful. If you did, please like, please comment, please subscribe, and I will speak to you next time. I've got a lot more videos to come from another portfolio update, more Simply Wall Street journals, when I'm going to be talking about dividends and a few other important factors. Going to have a video on the pound and what a weak pound might mean and how that can impact you investing. So, you know, all of that good stuff to come. So please like, please comment, please subscribe, please share the videos to anyone you might find interesting, and I will speak to you next time and catch you next time with another investment video. Take care, guys. Peace.